Hey everyone, welcome back to the channel. Today, we're diving into two super important topics in the world of auditing: subsequent events and the going concern assumption. These concepts are crucial for understanding the true financial health of a company right up to the moment an audit report is issued. So, let's get started. First up, what are subsequent events? Simply put, these are events that happen after the balance sheet date, but before the audit report is signed. Think of it like this: a company's financial year ends on December 31st, but the auditor doesn't finish their work and sign the report until, say, March 1st. Anything significant that happens in that 2-month window is a subsequent event. These events fall into two main categories. The first type provides new evidence about conditions that already existed at the balance sheet date. For example, if a major customer declares bankruptcy in January and it was already in financial trouble in December, the company needs to adjust its financial statements to reflect that bad debt. This is called an adjusting event. The second type involves conditions that did not exist at the balance sheet date, but arose afterward. Imagine the company's main factory burns down in a fire in February. This didn't exist as a problem on December 31st. In this case, the company doesn't change the numbers in the financial statements, but it must disclose this major event in the notes. This is a non-adjusting event, but it's vital information for anyone reading the financials. The auditor-'s job is to actively search for these events to ensure the final report is accurate and not misleading. Now, let's switch gears to the going concern assumption. This is a fundamental principle in accounting. It assumes that a company will continue to operate for the foreseeable future, which is usually considered to be at least 1 year from the financial statement date. Auditors have a huge responsibility here. They must evaluate whether there's substantial doubt about the company's ability to stay in business. So, what kind of red flags do auditors look for? Things like recurring operating losses, negative cash flows, defaulting on loans, losing a major customer, or legal proceedings that could threaten the company's existence. If the auditor finds these kinds of issues, they'll ask management for their plan to mitigate them. This could involve selling assets, borrowing more money, or restructuring debt. If management's plan is convincing and seems likely to work, the auditor might issue a standard, unqualified opinion, but will include a special paragraph in the report highlighting the going concern issue. However, if the auditor isn't convinced by the plan, or if the uncertainty is just too great, they might have to issue a modified opinion, like a qualified or even an adverse opinion, which is a serious warning to investors and creditors. So there you have it. Subsequent events and going concern are all about ensuring that the financial statements present a fair and up-to-date picture of a company's financial position. It's about looking beyond the numbers on a specific date and considering the bigger story. Thanks so much for watching. If you found this helpful, please give this video a thumbs up and subscribe for more content. See you in the next one.